Okay, in this video is all about basically some government policies and different factors that can impact net foreign debt. So we did talk about this in class, but I just wanted to create a video just to show you the sort of things you want to be talking about and the depth of your answers when you're talking about certain factors impacting net foreign debt. So the first one is trade liberalisation. Trade liberalisation is about free trade. And the thing with free trade is that it can have negative impacts for our debt because it can lead to us importing more in the short term. So because imports become cheaper, because they don't have tariffs and quotas and those kind of things put on them anymore, we may import more in the short term, and that can lead to a higher current account deficit, and because we have a higher current account deficit, it can lead to us going into more debt. But in the long term, the idea is that because we're forced to compete with foreign companies, or there's increased foreign competition, there's this idea that we need to become more productive, otherwise we're going to go out of business. So in the long term, the idea of trade liberalisation is that companies become more productive, they invest in capital, they invest in new infrastructure, they find ways to shift resources to areas where we have comparative advantage, or they specialise, and this should help us to boost our level of exports in the long term. So even though it can hurt the current account deficit in the short term, the long term idea is that we export more because there's lower tariffs on our exports, because we become more productive, and that leads to more credits in the balance of merchandise trade and net services, and leads to a lower current account deficit. And the lower current account deficit means there's less pressure on net foreign debt to fund that deficit. Labour market deregulation, again, that's all about removing government regulations. So what they can do is they can try and link our pay to productivity, which should make workers work harder, or they can get rid of the minimum wage to try and lower wage costs for businesses, or they can get rid of unfair dismissal laws so that so that employees will start working harder, and all of those things should help to reduce wage costs for businesses. So it should help to reduce wage costs, make businesses more productive because employees are getting paid based on how productive they are, and because our costs of production go down, it should make our exports more competitive, help to reduce the CAD, and put less pressure on net foreign debt because there'll be more export earnings. So when you're thinking of labour market deregulation, it's talking about things like getting rid of government involvement in the minimum wage, linking wages to productivity, getting rid of unfair dismissal laws, all about making businesses more productive in the long term. Reducing company tax rates. The idea with reduced company tax rates is it gives firms more money to invest. So it directly reduces their cost of production because they're paying less tax, and then they will invest in new technology, new machinery, and so on and so forth. This should make them more productive and therefore lead to lower prices, and that will make us able to export more and improve our international competitiveness going forward and lead to more exports. Reducing the current account deficit and reducing our need to borrow from overseas. So when you're talking about the company tax rate, think about the incentive for businesses to invest and then link that to more export spending or export revenue because we have lower prices. Same thing with spending on infrastructure. Spending on infrastructure helps to reduce bottlenecks and capacity constraints. By upgrading our roads and railways and ports, we should be able to become more productive. That's really key, and keep our prices down. And then again, there'll be more credits in the balance of merchandise trade because we'll be exporting more, importing less, and therefore that should help to reduce our level of debt. Again, it's all about increasing productivity and therefore making our exports more competitive. Spending on training and education, same thing. We become more skillful. That helps to lower production costs for businesses, helps to make our exports cheaper, more credits in the balance of merchandise trade, and therefore reduce debt. It could also lead to more revenue for the government because we've got a lot of skilled workers that are able to generate more profits, and therefore that helps to increase the level of government revenue. This is a hard one, increasing superannuation, compulsory superannuation contributions. The idea of doing this is there's two impacts you could talk about for the CAD. The first one is that because people are putting more money into their super, they don't have as much money to spend on imports in the short term, so it could potentially lead to a lower current account deficit because there's less import spending in the short term. And then in the long term, if people are putting more money into superannuation, the government doesn't have to put as much money into pensions anymore. So there's less pressure on the government to borrow money, or less pressure on public sector debt in the long term because the government doesn't have to spend as much money on pensions and retirees because people are funding their own super. So by keeping our budget deficits down, it helps to reduce the government section of public sector debt, and that's really important as well to try and reduce the pressure on the public's level of the government's level of debt. Lower terms of trade, and I'm going to leave it with these last two. I'm not going to discuss the last two because they're not going to be as relevant. But a lower terms of trade is really bad for our current account deficit because it means when we're selling our exports, we're not getting as high a price. So there's less money coming in, there's less revenue coming in, there's less credits in the balance of merchandise trade because when we're selling our goods, we're getting a lower price for them. And therefore, the current account deficit is more likely to go into deficit because the value of our exports is going down, because the price is lower. Assuming the volumes remain fairly constant, there's going to be a lower amount of credits in our balance of merchandise trade. It can also lead to more government debt because the government doesn't collect as much revenue in the form of income and company tax as the mining companies aren't making as much money. So that can potentially lead to bigger budget deficits. So the government section of public sector debt increases as well. Remembering from the last video that when we're talking about net foreign debt, we're talking mainly about the current account deficit and the government's level of debt, and both of those things will get hurt by the lower terms of trade. A higher exchange rate can have mixed impacts on net foreign debt. The negative is that it can reduce the demand for our exports because foreign currencies don't have as much purchasing power, so they're less likely to buy Australian products. This can lead to a bigger deficit in the balance of merchandise trade section of the current account. There'll be a lot less money coming in or less credits for exports. And we'll also be importing more because they're cheaper. But on the flip side, it can be good if we have debt denominated in foreign currency. So if we owe, for example, America $1 billion, then that might not be as much anymore if we owe them $1 billion US dollars, because the Australian dollar will have more buying power, so we don't have to pay them as much in Australian dollar terms. That can reduce the amount of interest we have to pay on our current account as well. So it can be good and bad for the current account. Generally, a higher Australian dollar will have negative impacts for the current account because of the impact on the balance of merchandise trade, but there are positives for reducing our interest. A higher Australian dollar is likely to be unfavourable for the budget because it means that export companies generally make less money, and therefore there's less income and company tax coming in through the fact that those exporting companies are making less money, and that can lead to more public sector debt. Thank you.